So the consequences are visible everywhere. Investor confidence, once a hallmark of Israel's economic stability, is evaporating. Foreign direct investment has plummeted. Major multinational corporations such as Intel and Samsung Next are pulling back or shutting operations. Sovereign wealth funds and institutional investors are divesting from Israeli companies, citing both reputational risk and practical concerns about stability. Meanwhile, the conscription of tens of thousands of reservists has gutted key sectors of the workforce, particularly that tech industry, which has long been Israel's economic engine. The fundamental question, therefore, is not whether Israel's economy is suffering, it is how long this downward spiral can continue before it reaches its inevitable economic breaking point. Israel's economic success has always been more fragile than its self congratulatory branding suggested. The high tech sector, celebrated as a model of Israeli innovation, is not only the backbone of the economy, but also its greatest vulnerability. High tech accounts for almost 20% of Israel's GDP, roughly half of its exports, and around a quarter of all tax revenues. This prosperity depends almost entirely on global integration, foreign capital, and investor confidence. Unlike natural resource economies, Israel's growth depends on intellectual capital, which can move quickly across borders. Before October of 2023, this model functioned because Israel managed to maintain the perception of stability, at least in the areas that mattered to international investors. It projected itself as a Western facing liberal democracy committed to economic openness, even if its treatment of Palestinians told a very different story. But the war shattered that illusion. The data is stark too.